So, good morning, good evening, whatever it is for you, and I am sure you are enjoying this quantitative finance course, learning something, checking books, checking the net, doing a lot of googling, reading research papers, doing the problems, because there is a whole lot of issues which we have gone through, and I am sure if you spend your time, definitely you will get all the concepts clear. And as I have been mentioning, as you are aware, there are different type of softwares which are available, which helps you to do all these problems in finance. So, you have the MATLAB, you have the R, you have the SPSS, SAS, so on and so forth. So, which I did not mention very explicitly, but considering that if you are really motivated, you can find out all this information on the net. So, continuing our discussion about different types of options, their combinations, whether the price is on an increasing trend, whether the price is on a decreasing trend, whether the price will be within some band, so on and so forth. So, we did consider combinations of first the combination of a forward and an option. So, that can be either a long or a short forward, then it could be different type of options, put and call. Then later on we considered that if there was a bullish market, bearish market, bullish means price are on the increasing trend and the person thinks the price will increase. Bearish trend means the price will decrease, how those options can be combined, a put and a call and so on and so forth. So, now we consider where we left is that, so we will consider the butterfly spread. The investor is hoping that the large stock movements are unlikely, that means they would basically fluctuate within a band. And whenever I say the large fluctuations, it will all to do with the ST, which is the spot price at time t, capital T, and we will compare how ST is varying with respect to the different type of delivery price you have. You have K1, K2, K3, K4 depending on how many different types of options you have, but also remember that underlying assumption is that the time to maturity for all the options would be of the same duration, which is capital T. So, here in the butterfly spread, the investor is hoping that the large stock prices movements are unlikely. So, if you see the profit function would be this portion which is as marked. So, large stock prices are unlikely. So, you have one option which is this with a strike price of K2 and another one is basically with K3 and this is basically K1. So, in case 1 which is a strike price of K2, you have received some money and correspondingly and for the other two options which is strike price of K1 and K3, you have bought that such that you have given out some money, the money has gone out of your pocket. So, technically we will try to draw these graphs considering K2 is the midpoint between K1 and K3, even though that need not be true, but thus being drawn in such a way that you will are able to get a good feel that how these different type of options are combined considering put, call and so on and so forth. Another thing, remember, we have assumed, and that is true, that the prices of these three options, whether P, C, small p and small c, what I am talking about, not the capital one C or the capital P which we have discussed about for the American one, we have all considering the European call and put. So, the small p and small c are of different values. So, they need, the reason being that because if you have different type of delivery price and considering the time to maturity the same, still you will have basically the prices at which they are being bought and sold are different. That is why these heights which you have drawn, this one and this one are all different. So, if you combine them, you will see that for any movement of the stock price ST being less than SK1, being greater than K3 or being between K1 and K2, the price fluctuation which you are seeing is within a certain band. So, that means the person thinks that any price fluctuation between K1 and K2, K3, you will always make some profit considering that you are able to hedge to the best possible extent, and any negative movement, negative means either it is below K1 or the ST is basically over K3, you will basically have formulated your options in such a way that you will make minimal loss. Because if you consider this only, case 1 or case 2, for prices below K1 obviously this is a loss, but on the other hand prices greater than K1 and greater than K3 obviously this is a gain. this is fine for you, the gains are fine for you, but what you are more interested is that if there is a loss, the loss should be as minimal as possible. But on the other hand, if you consider the other option, for prices less than K2, you will make a profit because you have got a money and the person would not be exercising it. But the moment the prices are greater than K1, obviously the person exercises and you make a whole amount of loss. So, this loss is being compensated by the positive gains which you are doing, such that the overall loss or gain whatever you have is basically bounded between the small bandwidth. So, what you have been able to do is that combine the options in such a way that any marked fluctuation greater than K3, less than K1, you make minimal loss, and any variation within a bandwidth which you think is possible, you are able to make some profit, in the sense you are able to minimize your overall loss. So, this is what you see, and you have basically formulated the butterfly using calls. So, that was the diagram. Now, let us basically consider the matrix. So, what you have is basically the first column as usual is the ST in different domain, then you have the long call, then you have the short call, and you have basically the long call. So, if you see, I have written it in this fashion, or in the book John C. Elway will written it, see it in this fashion. The strike price for the long call, the number 1, which is the second column, would basically be K1. This would be K1. The delivery price for the short call is basically K2, and for the next one is K3, and so on and so forth. So, what we have done is that written this in such a way that the increasing delivery price would basically be written on first column, second column. First column means this one, the first column, second column, third column, fourth column, and so on and so forth, where technically the 0th column has the values which are basically the domain of ST, whether ST is between K1 and K2, whether ST is greater than K2 and less than K3, and so on and so forth. So, if you see, in this case the overall profit which is being given, I didn't get any extra column, that is why I have wrote it down. So, hence the total profit will be this. That means, you had basically paid 2 amount. So, these are the total amount of money which has gone from your pocket for the long call, the first one, and long call, the second one, and the total amount of money which you have received is basically the short call one, which is again C, but with the suffix of SC, which is for the short call. LC1 and LC2 is basically for the long call 1 and long call 2. Now, in the next case, when K is between K1 and K2, again you see the first one is activated and the second and third are not, hence the total now the value of the option is given by the values of minus CL to C continues as it is, plus CSC, which is the short call price, also continues. Whoever the person is has basically exercised in that way, hence the profit would now consider this extra term also. Now, as you move to the next higher level, when ST is between K2 and K3, which means what? The long call will be activated, the short call will be activated. Long call means the first long call, while the second long call would not be activated. Hence, the profit would now be, the first portion is basically for the first long call, second is basically the portion for the short call, and the long call 2 remains as it is. Now, when you basically go to the third instant, that ST is greater than K3, now all 3 will be activated, hence the price would be, or the total profit would be the sum of the first one, which is this one, the second one, which is this one, and the third one, which is this one, where first, second, third implies the long call 1, the short call, and the long call 2. So, the overall profit is given. So, whenever you have this overall profit, remember you can draw and retrace back and understand how the graph looks like. Now, we are basically formulating puts. So, they can be different puts, a long put, short put, and different combinations of that, different strike prices. So, we have considered the strike prices are as usual K1, K2, K3. Again, we are assuming inherently that the prices are moving within this bracket, which is K1 and K3, and the prices for any untoward movement of the prices greater than K3 or less than K1, the prices movement have been made in such a way using this put options, that the overall profit in regions of less than K1 and greater than K3 obviously are minimum, such there is no much fluctuation. So, whatever fluctuation is happening is between the bandwidth of K1 and K3. Again, consider K2 has been drawn in such a way that is the midpoint of K1 and K3. Also remember the time to maturity are same and they are of the same type of European option. If you follow the same fundamental principle, the 0th column or the first column, whatever you denote, is the domain space of ST. In the first instant, ST is less than K1. In the second instant, which is this one, it is basically ST is between K1 and K2. In the third instant, ST is between K2 and K3. And the final instant, you have basically the last row is ST is greater than K3. And again, in the similar way, the first column, the second column, and the third column are the different type of puts. In the first column, you have the long put 1. In the second one, you have basically short put, only short, there is only one short put, so this is short put. And the last column is basically again long put 2. So, you can have basically short put 2, long put 3 and so on and so forth. So, you can definitely do different type of combinations. So, again in the same way, in the first instant when ST is less than K1, well, all these threes are activated. So, what I am circling now, the first, the second and the third are the respective profits which is happening from the long put 1, this is long put 1, this is the short put and this is the long put 2. Remember also P is the price of the put and the suffix like LP1 is basically the long put 1, SP is the short put 1, LP2 is the long put 2. If you go to the next row, there you will see that for the first instant which is long put 1, it would not be exercised, hence the price which has gone out of your pocket is the negative one. The next two columns which is the short put and the long put 2 have been exercised, hence the profits are denoted as it is, and this is the one for the first instant. Similarly, as you go step by step, in the case when ST is between K2 and K3, the long put 1 and short put are not exercised, the long put 2 is exercised, and the last instant when ST is greater than K3, none of them will be exercised, hence the overall profit would be the combination of, I am not mentioning the sign, but it will be P which is the price of that put option, suffix LP1 which is for the long put 1, then you have basically P with the suffix SP which is with the short put, and the last one is P again with the suffix LP2 which is for the long put 2. So, whether a minus sign will come or a plus sign will come would depend on whether you have bought that option or sold that option. Similarly, as we have considered in the calls also. So, whatever the combinations are for a call and put, in the first instant we have only considered the call, in the second instant we have only considered the put. Now, your question would be whether we can combine different calls and puts. The answer is yes, depending on whatever you think are the scenarios, whether the prices are on an increasing trend, prices are on a decreasing trend, prices would be fluctuating between one level K1 and K2, prices would be fluctuating between two different levels K1 and K2 in one instant, or say for example K4 and K5 in other instance. So, you basically have different type of puts and calls depending on what you think is the best option in order to minimize your overall risk or the loss. So, remember another thing which I am mentioning time and again, the underlying fact remains that the options are being combined in such a way that you want to hedge or minimize your overall risk. Now, we will consider the trading strategies involving combinations of forward and options in order to reduce the risk. So, we have already done so in similar fashion, but we will see that how the overall risk are being minimized. So, by the word risk I always mean or will always mean some sort of monetary value, rupees, dollars, yens, pounds, Australian dollars, Canadian dollars, Australian pounds, whatever it is, you will always consider that you are trying to minimize. And when you are trying to minimize, remember one thing, that as you have done for the swaps, that means when you are doing the case that you are in domestic country and you are trying to basically find out a swap for a foreign country, and you consider R and R star, where R is basically the risk free interest rate for the domestic country and R star is basically the risk free rate for the foreign currency, and you consider the domestic currency with respect to the foreign currency or vice versa depending on wherever you are, you will basically consider the same concept in a way such that the options and the futures have been done in such a way that your overall unit based on which you are trying to measure the loss would be only one currency. There may be instances where we will see later on that the risk can be termed as variance, risk can be termed as standard deviation, risk can be termed as value at risk, risk can be termed as conditional value at risk, whatever it is, or it can be beta also, or it can be the ratio of expected value to the standard deviation, or it can be ratio of expected value to the beta. So, if you remember, we have done different type of problem solving using the ratios, where you rank them from the highest to the lowest of the ratio of excess return over the risk free interest rate divided by standard deviation, or the excess return of the returns over the risk free interest rate divided by the beta. So, we consider different concept of risk. So, they are basically some sort of loss in a very simple sense. For the problems which we will discuss, we will denote the delivery price always by x. It can be k or x, but we will continue with the concept of x as the delivery price. So, now consider we have already done that, but now I will give you a very good pictorial notation that how we can reduce this risk, because if you can understand this through the diagrams, it will definitely make much sense. I have purposefully not given the matrices. The reason is that not the matrices would not have made the pictures clear, but what is more important is to understand and visually see that how the risk is being reduced. The moment you understand that, then making the histogram or the matrices would be much easier for you, and then when you have the matrices, you can again revert back to the diagrams and have a good look. So, rather than going into the details of the matrices, I am only giving you a good understanding about the pictorial concept. Once you understand the pictorial concept, try to do and solve the problems from John Searle or whatever, whichever other book you are trying to follow, and use first make the matrices, and once you have the matrices, then you basically are able to do it in a pictorial sense. Another thing which I would definitely urge the students to do, that because computers being available readily, use Excel sheet to basically make these matrices. So, once you have the Excel sheet, in the first column, remember always plot ST in the different domains, and in the second, third, fourth, fifth column, whatever you have, draw the different type of call and put which you have, long call, short call, long put, short put, whatever it is. And once you do that, last column would be the cumulative profit and loss. Once you have that, you can basically draw the first column which is S variation of ST with the last column which is the cumulative profit, and that will give you a good conceptual framework that how from the matrix you can basically draw the diagram in order to understand that how the different type of options can be combined, keeping in mind that different type of fluctuations of the ST prices, whether it is on the lower trend or whether it is on the upper trend, whether it is basically being bounded between two values. So, you can understand the overall sequence of how the options can be made in such a way that the overall risk is minimized. So, again coming back the pictorial concept. Initially, we have a long forward and the risk is as shown. So, what I am trying to make you understand is that where the risk is and how you combine in order to reduce the risk. So, let us go step by step. So, considering the prices generally would be a downward trend, in this diagram the forward which you have, the overall hashed lines which you have, this portion which is the diagram or the triangle ABC. So, this is the overall loss. So, now you will be asking yourself, well, obviously there is a profit also in the case the ST prices is greater than X1, that is true, but what we are more concerned is the loss. So, our loss is basically this pink one highlighted, this is the loss which is to be reduced. How do you reduce it? So, let us go the next step. This was a long forward position, now you are basically trying to combine with a short call option. So, now combine with the short call option, we have already done that, but this is a much more explicit view of the diagrams. So, initial loss was this one, now you combine with short call option, the combined position is the dark blue one, and see your overall loss has been reduced. So, initially it was A, B, C, now it is A, B1, C1. And you can understand, and C1, and you can understand the overall area of A, B, C is much more than A, B1, C1, hence you can definitely say that the loss has been reduced. So, now it gives you a good pictorial way that how the overall loss has been reduced using a long forward and a short call option. Now, we will basically again go back to the same example, but basically take a different strategy. Now, we had a long forward position, again this is the loss, and the loss is marked by A, B and C. If ST is greater than X1, obviously there is no loss. For any values of ST less than X1, you have a loss. So, initially we only have a long forward and the risk is as shown, considering prices will generally go on a downward trend. So, in both the examples is on a downward trend. Now, with this long forward we combine a long option and the cumulative payoff is basically the bold blue line which is shown and is like this. So, initially it was A, B, C. Now, when you combine it, what you have is basically A, B1 and this again C. So, initially this was the overall loss, now this is the loss. So, generally I am trying to let us make it much more explicit. So, I will denote it by C1. So, initially the loss was A, B, C, now the loss is A, B1, C1 such that you have been able to combine a long forward, combining with the long put option and the cumulative payoff is being shown in the blue bold line. Remember one thing, in both the examples a long forward has been combined with an option, but with the notion that the prices are on a downward trend. So, we will consider later on that if the prices increase how they can be combined. Thank you.